Earnings season is a period of heightened volatility. Many traders get caught up in the initial price swings after a report. They react to headlines without digging deeper. A significant price drop doesn't always mean the company is in trouble. Often, the market overreacts. Panic selling takes over, driven by emotion, not logic. That creates an opportunity for disciplined traders. Don't follow the crowd. Identify where the crowd is wrong. True alpha comes from capitalizing on temporary mispricing driven by fear. Step 1. Filter for fundamental quality. A stock that merely drops is not a buy. Look for fundamentally sound companies unfairly punished. Did the company beat earnings? Did the company beat revenue expectations? Sometimes stocks fall despite a beat, often because guidance missed lofty analyst expectations. Look past the noise. Read the earnings transcript. Listen to the conference call replay. Once you've confirmed the company's fundamental health, you must turn to the chart. Price never lies. A falling stock needs to find a floor before it can bounce. We look for logical areas where buyers might step in. These are support zones. Prior pivot lows. 50-day moving average, 200-day moving average. Previous consolidation area the stock broke out from. Example, a stock pulling back to its 200-day MA after a strong earnings report. Classic setup. Institutions that missed the initial run-up may see value at that area. Next, watch for price action signals that show selling is exhausting. Look for sellers losing control and buyers taking over. Hammer candlestick. Shows a sharp sell-off during the day, then a rally to close near the open. Long lower wick. Failed breakdown. Price briefly undercuts support then quickly reclaims it, trapping aggressive shorts. Tight consolidation. Stock trades in a narrow range for days after a steep decline. Volatility contracts. The market coils. Coiling often precedes an explosive move. Breakout to the upside from tight consolidation signals buyers won. Next leg up begins. Never guess the exact bottom. Let price action prove the turn. Better to buy a little late and be right than too early and be wrong. Patience is paramount. Waiting for a hammer, failed breakdown, or tight consolidation gives concrete evidence the stock is changing character. Price action alone is not enough. You must have confirmation. The most important confirming indicator is volume. Volume is the fuel that powers price moves. See a reversal pattern, like a hammer candle. But you want it on a significant surge in volume. High volume on a reversal day indicates a transfer of shares from weak hands, panicked sellers to strong hands, institutional buyers. It signals commitment. A reversal on low volume is suspect and likely to fail. A massive volume spike at key support is a clear sign big money is buying. Once price and volume align, use momentum indicators for a final check. The average directional index, ASDX, is excellent here. For longs, you want ASDX to flatten and decline from a high level, typically above 40. The Commodity Channel Index, CCI, measures deviation from average price. The trigger is CCI moving back up and crossing above -100. A falling ASDX plus CCI crossing above -100 is strong confirmation. Your entry trigger is the moment the stock breaks above the high of the reversal day or moves out of its tight consolidation range. This is your green light. Enter the trade decisively, but always with a predefined risk management plan. Your stop loss should be placed at a logical level that invalidates your trade thesis. Typically just below the low of the reversal day or below the bottom of the consolidation pattern. This protects your capital from a larger than expected loss. Setting profit targets is just as important as setting a stop loss. First target, the 50-day moving average if the stock is below it, or a retest of the price level from which the stock initially gapped down, or prior areas of resistance. As the stock approaches your target, sell a portion to lock in gains. Trail your stop on the remaining shares to let the winner run. Aim for at least a 2-to-1 or 3-to-1 reward for the risk taken. Keep a detailed trading journal. For every trade, record your reasons for entry, technical setup, fundamental catalysts, and why you believed it was an overreaction. Take a screenshot of the chart. Annotate your entry point, stop loss, and profit targets. After the trade is closed, record the outcome. Whether it was a win or a loss, write down the lessons learned. Refine your strategy and learn from mistakes.